Hands down, my favorite option strategy is the covered strangle. This video is going to go into exactly why, and it's for two reasons. It's extremely adaptable to most market conditions, and once you create a sound strategy around the covered strangle option structure, it allows you to benefit from different market forces in different market conditions. And I'll explain exactly why that's the case in just a minute. So what's up, everybody? Eric here. Welcome back to All the Outliers, and a huge shout out to the Patreon members and YouTube members. You guys make creating content like this possible for me, so thank you guys. And if you enjoy my content, consider signing up. Helps me a lot. With that, let's get right to it. Executive summary. So for those that don't know, I'm really big into organization, and I will throw a link in the notes below on the concept of trading plans and strategy outlines. This is kind of the excerpt of a strategy outline that walks through how I view the strategy, how I intend to deploy it. The executive summary is like the acid test. It's just an overview of what it is succinctly. So the covered strangle is designed to maintain market exposure. So I trade the covered strangle in almost every single market condition. It's primarily a bullish strategy. The market exhibits positive drift over a long-term time frame, so it allows me to expose myself to that, but we can enhance the buy and hold return, because one of the downsides of buy and hold is when the market goes down, you lose out on a lot of opportunity in buy and hold because you just essentially have to get it, buy and hold. But in this case, we can use options around a otherwise buy and hold strategy to really amplify the return potential. So what's the setup here? What does this thing actually look like? Well, real simple, really. It's going to start with a cash secured put, then it's going to have long stock, and then it's going to have a covered call. Let's take a quick look at each of those by themselves first. If we pull up the platform, you can see a trade that I have on right now in IWM, which is a covered strangle. And let's take a look at each of these individual legs. So first we have the cash secured puts. Cash secured puts will have limited profit potential. It's defined at the onset of the trade and technically undefined risk down to zero. Then we have the covered call. This part is actually really important. First, it's going to start with the long stock, right? So long equity, you've seen this before. It's just a positive sloping line. For anybody that's looking at this chart saying, what the hell is this? This is literally just a risk profile, but it shows you your profit and loss at different stock prices. So the y-axis is our P&L, and then the x-axis is the price in the underlying. So long stock, it's just upward sloping, right? You dollar for dollar, you move with the underlying. Now, right now I'm long 800 shares of IWM at 181.94. So covered call typically looks like this, where if we have long 800 shares, we would be short 8 calls against it. And notice how we cap our upside potential. Now, right now, my covered call actually looks like this. Notice how it has unlimited upside potential. This is for a very particular reason. I do not sell short calls to long stock at a 1-to-1 ratio typically. We'll get into different circumstances on what ratios you would want to use when, but the guiding feature here is if I'm long 800 shares at 181.94 and I'm short 6 short calls at 182, which is above my basis, I have 200 shares that are uncapped. That's why I do not have capped upside potential. One of the largest drawbacks of the covered call is capped upside potential. We accept some money up front, but then we give up our upside potential, and a lot of times the stock will run, and then you're like, well, damn it, I'm missing out on a lot of gains for a little bit of a credit up front.
Say something, goddammit. You're on television.
This allows us to create balance. So in this case, if I want to unwind the position, sure, I might sell 8 short calls against the long 800 shares in the hopes that all 800 get called away, and I'm okay with that. But in other instances, you can modulate how many short calls you sell, and we'll get into what that trade-off looks like in a little bit. So those are the legs. That's it. It's really not that complicated. So I want to run you through overall management real quick, because I just gave you what the max profit and the max loss is for each of those. But let's take a look at P&L management. For the cash secured put, I'm typically going to look at something around 65% max profit. I personally use a sliding scale that's IV adjusted days to expiration. I'm not going to go into that into this video because it really doesn't offer that big of an enhancement over this as a general approach. Then for the long stock, normally I'm just going to use support and resistance using moving averages, linear regression channels, kind of what you you typically would do when you're trading. So whatever your overall approach is to managing long stock positions, that's what I would apply here. Now, the products I trade make this slightly different. And in general, I'm mostly going to be looking at taking profit when I want to unwind the position. But I overall look at things like moving averages, linear regression channels, because I don't want to ride things all the way down if I don't have to. We'll get into that in a little bit. But overall, that's what I'm looking at for the cash secured put and the long stock. For the covered call, the profit is just going to be managed at whatever the short strike is. And I'm going to let it expire more often than not. We can get into managing the covered call section of the trade when it's in the money in a little bit. But overall, that's what I'm going to do. That's why I'm selling the short strike on those calls, because I'm comfortable unwinding there. So for the loss side, because I trade very curated products for this strategy, my loss management is very different than just about every other strategy that I run. In this case, if you are trading a normal stock, like a growth stock, something that you hope goes up, but you're not super convicted, your technical analysis, makes you believe that you're pretty, confident that it's going to move in your direction, but not totally, then I would apply your general loss management approach to any other long stock position that you have, meaning I normally would use support and resistance in the broader trend. I'm going to go into why when I'm trading my variation of this strategy, I don't really follow this, because I really don't take many losses in this strategy at all. And that's not like some sort of huge flex. I'm always right. I'm not.
You're joking, right?
There are periods where I'm very wrong, but the way I structure the strategy, I'm okay being wrong and holding an unrealized loss for periods of time, provided that we manage the rest of the strategy correctly, which we're going to get into in just a second. So from here, let's talk about the process so that you get a feel for how this works. First, we are going to have that cash secured put, and that's typically how I'm going to enter the trade. From there are two scenarios. That cash secured put can be out of the money, in which we would sell again, or it can be in the money. And then if it's in the money, you have three choices. You can close those in the money short puts for a loss. I very rarely, pretty much never do that. You could roll them out. I do this very frequently. Or you can take assignment. If you take assignment, there are a few other scenarios that happen here. You're now going to be long shares, because cash secured put means part of that bargain is if you're assigned, you're going to buy the underlying at your strike price. So you're going to be long at your strike price. That's when I would offer those covered calls at a ratio. At the same time, I'm going to sell more cash secured puts. The way I manage this is by creating very careful scaling protocols that allow me to have capital to continue to add more cash secured puts to manage the basis. This is one of the biggest differences in this strategy compared to anything else. In general, adding to losing trades is a poor prospect. In this scenario, it's slightly different, because what I'm doing is very carefully manipulating my basis on the way down when things aren't working. There is a period of time where it's painful. You're holding something that's losing money. It's uncomfortable. But notice how I'm trading IWM. I've never seen any sort of US based broad market index not make new highs at some point. So if my hypothesis in that changed eventually, sure, I would take a loss, no problem. But this isn't Japan. Japan has that scenario where they still haven't made new highs. But if we zoom all the way out, this is going back essentially to the inception of IWM. We've never not made new highs at some point in time. Even if we take a look very quickly at SPX, another broad base, well, really we would use SPY, but SPX just lets us go back further in time. Notice how we've gone down before, but we've never not made new highs. That part is so important to the strategy, because there's no other scenario that I would feel comfortable adding risk on the way down. But in this scenario, I do feel comfortable. You just have to be patient. So in this scenario, we now have essentially the full covered strangle, where we're long the equity, we have the ratio covered call, and we have the cash secured put out. That is the entire setup. Now, in this scenario, if you're trying to avoid assignment, which I'll get into the trade-offs here in a minute, and you choose to roll those short puts, then really you're just up here. You just go back up to selling and managing the cash secured put. Now, I want to talk to you real quick about the covered call side, because now we have more options. We have the cash secured puts that we're managing, which I went over up here. And now we have the covered calls, where there's two scenarios. Either they're going to be out of the money, and if they're out of the money, we're just going to offer more covered calls. And then if they're in the money, we allow them to be assigned assigned, or we can roll them. If we roll them, we just go back up here to the covered call and keep managing it as is. Again, the main differentiation between how I'm going to roll short puts versus short calls. Short puts, I typically roll pretty aggressively to manage my basis so I don't get stuck at a top. The short calls, I rarely will roll unless I can clearly make a lot more money, but otherwise allowing assignment here is a big part of the strategy because it frees up capital of long equity that we can now offer again via the cash secured puts. Let's now talk about the products. I gave you a little bit of a preamble, but this is such an important aspect to the strategy. I'm going to look for very liquid products, ideally that have weeklies. The weeklies aren't always super liquid, but if something offers weeklies, generally speaking, it's going to be liquid because there's at least some demand there. But overall, I'm going to focus on liquidity. What's liquid? You can essentially look at ETFs, large cap stocks, those kind of products. The reason why liquidity matters in this case is because there are periods of time where you're rolling deep in the money options. If they're not liquid, you're going to get eaten alive in those instances. I sometimes will prioritize a dividend. Sometimes I won't. If I'm looking for a dividend, I would want something at least 2% if it's offering a dividend. If I'm trading an index ETF, I sacrifice some of that. The reason why I like these products and specifically why I like IWM versus the SPY, for example, I'll actually throw a video in the notes below why I prefer SPY over IWM.
What did you say?
Psych, I totally dorked that up. I mean, why I like IWM over SPY, but it really comes down to diversification of the products and volatility. Typically speaking, IWM is going to have slightly more volatility on average, which when we're selling options, we want that. The other thing is diversification. If you take a look at the S&P 500, notice there's a lot of products, but Microsoft, Apple, Google, Meta, they make up a lot of the index. Whereas you look at the Russell 2000, that's really not the case. It's very well diversified. The top 10 holdings make up like 2% of this product, whereas this, it's like 20%. So overall, you're going to get better diversification and volatility in IWM, but sometimes you could trade individual large cap stocks if you're looking for a little bit more growth. I don't do that so much anymore myself, but I definitely did back in the day when I was trying to aggressively grow the account. Now, for implied volatility, like I said, we are trading options and short options. So in general, I am going to prefer periods where implied volatility is going to be trending over realized volatility, meaning the variance risk premiums are a little more in vogue, if you will. So if I zoom in here to a 6-month daily, we can see essentially that trend between the yellow and the white lines. I want to be very clear. This is not a determining factor on whether or not I'm going to put the product on, but this is sometimes an informing factor in terms of what scaling protocols I'm going to implement and what initial size I'm going to offer. This becomes important then. So I'm going to get more aggressive when implied volatility percentile is above 20% typically, but most importantly, when this relationship widens, when the variance risk premiums are greater. And if you're unfamiliar with that concept, I'll throw a link in the notes below on variance risk premiums. Very similar to the volatility side of the equation for technical analysis, fundamental analysis. The way I think about this is it is a long-term position, meaning the hypothesis for this could be a 1-year hold, a 2-year hold, a 3-year hold, but it's comprising of a bunch of short-term trades as well. So apply the correct analysis that fits your approach to these things. For me, I'm going to look at different time frames. When I'm trading something like IWM for the covered strangle, again, based on my technical analysis, I'm not necessarily not going to trade it. But if I wanted to, let's say this wasn't IWM, let's say that this was just stock XYZ, probably wouldn't buy it here. I would want to see it break above 180 essentially, but really it has a lot of downward pressure. But with IWM, I don't care as much because I'm amplifying the position with options and it's a longer term hold. So the way that I'm applying this analysis is more to inform me on how much I want to offer initially and then how I'm going to scale into the position. So I'm going to look at things like moving averages. I'm going to look at things like linear regression channels. I will throw a video in the notes below that walks through the technical analysis I typically like to use. Then for individual stocks, fundamental analysis is really important. I'm going to be looking at things like sales, revenue, overall profitability of the company, which if we take a quick look at a scan, this is just a very general scan that I use. This is looking within the S&P 500 that has weeklies. I'm looking looking for something that's solvent, has a decent quick ratio. Typically, I prefer it above 1. That revenue is continuing to grow, sales per share is continuing to grow, that it's trading above the 50-period EMA, the 20-period EMA. You could pick different EMAs. But then I'm also going to look at all these other kind of ratios: cash flow, relative value, free cash flow, PE ratios, stuff like that. But because I'm typically trading in index ETF, I actually don't care quite as much. So let's now pivot over to best practices. We're going to talk about all of these, specifically how to think about them and what the trade-offs are for each. So for the cash secured put side of it, I'm typically going to offer at a delta of 0.15 to 0.5. The trade-off here, the way to think about it is, do you want to sell a 20 delta or a 30 delta? The higher the delta you sell, the more upfront money you are going to collect. However, the trade-off is the probability of it falling in the money and requiring management is going to be greater. That's your trade-off. The other thing to consider is that the lower delta you sell, the lower the basis is going to be. Those are the two primary inputs that I think about when I'm choosing a delta. The other thing to keep in mind is the distance off of highs. And this kind of bleeds into number 2 here. But if we're very close to market highs, I'm typically going to favor a lower delta, like a 20 or 25 delta. And that's just because the propensity for us to fall down becomes greater if we're revving right against highs. Now, one of the premier aspects of my strategy is sizing and scaling. The way I think about this is every single trade I put on has 3 features. It has a total capital allocation. How much money am I going to give to this trade in total? I define that up front. Then the initial outlay is the second piece. What is my initial offering going to be as a percentage of my total allocation? Then the third thing, based on that remaining amount of money that's not used in the initial outlay, how do I scale into the trade? So the way to think about the trade-offs here is the allocation is what it is. That's whatever fits into your portfolio. This comprises the core allocation of my core portfolio. So I'm very generous with the total allocation. I like to split my portfolio into 2 buckets, core and speculative. Core being my main effort, as we would say in the Marine Corps. That's my bid for success. It's how I want to meet my primary investing objectives. So I'm very generous with my allocations there. So that's the total allocation. For the initial outlay, I'm going to look at 2 things. I'm going to look at our percentages off of all-time highs. The closer we are to all-time highs, the less I'm going to offer, maybe like 20%, 30%, and also implied volatility. If we're really close to all-time highs and implied volatility is very low, I'm going to scale down quite a bit because you stand to lose more than you really stand to make. It becomes difficult to trade the strategy. The way to think about the initial outlay is if it's a bigger outlay, you're going to make more money up front. It's a bigger credit, right? Larger position, but you sacrifice being able to scale in on the way down. So for example, coming back to this during COVID, which is a really great recent example. If we were trading here where volatility was low and we were near highs relative to the point in time, if I was like fully allocated here, I would have had nothing to add on the way down. I would have essentially had to sit on my hands and wait until we rallied out of here and then made new highs. That's okay. It's not a worst case scenario because you're still eventually going to make money, but that's not what I'm looking for. I want to be able to scale in on the way down so that as we make this V-shaped recovery, which I didn't know at the point in time, as we make that recovery, I can make a lot more money. So it is important to note that when we're thinking about scaling, it's a tricky prospect. I typically am going to use something like each 5% decline, I'm going to look at deploying something, whether it's 5% of my remaining allocation, 10%. You have to figure out what's right for you, but you have to think about scaling as silver bullets, because going back to this example, if let's say I had 80% allocated. So let's say I had $100 in this position and I wanted to scale in on the way down. If I had no money left to scale, I could only scale in $20 more. Your basis isn't going to change that much. Now, let's say you had $1,000. I'm just using round numbers because I'm an idiot and it's easier for me.
Well, if I say yes, I'm an idiot, right?
But let's say you have $1,000 allocated to this trade, but you enter with $100. Now, if you scale in with another $100 up here, your basis is going to be the difference between those two. Not bad, good basis improvement. In order to get the same kind of basis improvement again, now you have $200 in the trade, you have to add $200. So you went from 100 utilization to 200 utilization to 400 utilization. If you wanted to do that again, now you're at 800 utilization. The point being, the more you add to the trade, the more money you need to make a meaningful impact on your basis. So I like to scale meaningfully up front, but then slow down and wait on the way down, because the average bear market is 298 days. So I actually left a lot of money on the table here because I was scaling in based on my typical protocols, which again is keeping in mind a longer bear market, which we didn't get. So I left a lot of money on the table, but I was geared up for a much worse case scenario, so that whenever we eventually do bottom, my basis is decent enough that I can continue to trade options around it, because this goes into number 3. My short call delta, I prefer it to be above the basis of my shares. So right now, again, is a great example of this. If we go to the Analyze tab and we put on the actual trade that I have, which is short 2 separate lots of puts, I'm long 800 shares, short 6 calls. My basis is 181. That's over here. But IWM is trading down here at 176. So by scaling in, I didn't start the trade with 800 shares. I started with probably 200 or 400 shares. But by scaling in on the way down, I was able to improve my basis enough to at least be able to sell calls against it that allow me to collect something reasonable. If your basis is too high, you lose the ability to sell short calls above your basis, because if you do short calls, if you sell them below your basis, you're now possibly locking in a loss, which sucks, especially if you've been holding the trade for a long time. So I really look to avoid that. And then at a ratio, because we get to maintain upside potential. We already went through technical analysis, fundamental analysis. All of this stuff is really what drives how much I want to scale, when I want to take profits. The most important part is don't fall in love with specifically if they're individual stocks. Stay sensitive to whatever your benchmarks are. Now, days to expiration. For pretty much all of these, I'm going to be looking at something between 0 and 50 days out. I base that on implied volatility and then the current market conditions. Here's why. If the markets are really low implied volatility and steadily grinding higher, I'm going to favor the longer duration so that I can collect enough money for the trade to make sense. I'm looking for about a 1% return on invested capital for the cash secured puts. So if you're not able to get that because implied volatility is too low, you kind of have to add more time. If you're in markets like we see now, you don't actually have to do that. So I tend to prefer shorter term time frames, and it's for several reasons. 1, variance risk premiums are going to be higher. 2, it allows me to be more sensitive to current spot price movements so that if I decide to manage the trade, I have more opportunity. What do I mean by that? Great question. Let me show you. So if we pull up this options chain, let's say right now I have short puts out in 22 May. If these fell in the money, I could roll them out to 24 May, add 2 days. I can roll them out to 26 May, to 30 May. Because of the weekly expirations, I have a ton of choices, because the trade-off here is the further out in time you go, the more money you collect, but you have to wait longer first, but you lose sensitivity. What I mean by that is, let's say instead I had these short puts out 41 days out, and then they fall in the money quickly. Well, the next roll I have available is 62 days, then 90 days. So instead of adding 2 days to the trade that I have to wait, I'm now adding 30 at a clip. So that's the trade-off here. The shorter term timeframes you can trade, typically I prefer. You're going to get better theta decay, but in low implied volatility environments, slowly ascending markets, it's difficult to do that. Now for rolling or rolling versus assignment, a couple things to keep in mind. For the short puts or the short calls, the best time to roll, meaning when you have the most choices, whether you want to roll out in time, not too far, or out in time and up or down, depending on if it's a put or a call. When the stock equals your strike price, that's when you're going to have the most opportunities. But you have to balance a few things. You have to balance how much time value you're buying buying back. So if we go to this example, and let's say I wanted to roll these puts for whatever reason, I'm buying back $30 that otherwise would decay out. So that's the time value you're buying back. That I don't want to do that. I want to make money on the time value, not buy it back. Then you also have to think about sensitivity to days to expiration, which I just went over, making sure that we can try to stay close in time to give us more choices. We have better theta decay because the theta decay curve is going to be really fast in here. And if you need to roll, you have more expirations available to you without going super far out in time, but then also your basis, because sometimes as the markets just continue to grind down, those short puts can get really tricky, and you have to figure out the best way for you to manage your basis. And sometimes you have to go, instead of going 2 days out or 4 days out, you have to go 20 days out. But this way, instead of your basis, let's say these 174s were in the money, let's say you looked 2 days out or 4 days out and you're like, okay, well, I can roll those 174s to 172. But let's say you go 20 days out and you're like, okay, well, I can actually get them to 164 now for a credit. That's really impactful. And that hits an important concept when we're rolling. In either of these instances, I'm going to look for a credit. If you can't get a credit, sometimes a small debit is okay, provided the overall position is still profitable, which I have a bunch of videos on rolling and how you can track that math. I'll throw those in the notes below. But the trade-off here simply comes down to, do you want to roll to improve your basis? Do you want to improve your profitability? Or do you want to allow assignment? Specifically, if it's short calls, for example, I'm typically going to err on just allowing them to be assigned. But if you can roll and make some more money, that's okay. So the last thing I want to talk about here is the allocated capital, because this is a capital intensive strategy. So one of the things I talk about now is being able to actually put the capital you have allocated to the trade into something that earns the risk-free rate, so we can kind of double dip. This is something that a lot of people don't think about. So for example, let's say that we're going to put $100,000 allocated to this strategy. You're going to use $20,000 up front. You might not even need all $20,000 if you're selling puts, and then you have $80,000 that's just sitting there. Typically what I'll do is I'll take the money that's not being used and I'll put it into box spreads, and I'll just be careful about the timing. So let's say, for example, I have short puts expiring 26 May. Right now, I have box spreads out in SPX that expire 24 May, or that even expired yesterday. Today's the 20th of May, so that I can cover these as well if I'm to get assigned. So by deconflicting the timing of the box spread, it allows you to capture the risk-free rate on the capital that otherwise would just be sitting there. And this is more pertinent now because the risk-free rate's over 5%. So you could put in a 10-day box spread and at least make something on it as compared to the money just sitting there. So I'll throw a video below on box spreads so that you could figure out how I like to think about those and using that to really maximize the profit potential of the strategy. So that's the overview of the covered strangle. I know you're thinking 30-minute video, how can that be an overview? I've spent a lot of time developing the strategy. So I'll throw a playlist below that walks through a bunch of live trades that I have on how I manage them, how I look at the current markets to manage the trade in that scenario, because I traded so much. If you enjoyed the video, please like, subscribe, share. It really helps me grow. I appreciate you guys watching the video, and don't forget to be an outlier. I'll see you guys later.